Okay, everyone, step right up. The American economy has turned into a casino. What are your bets? Trillions of dollars on AI, tariffs, and Wall Street hype. Now, who are the players? Politicians, tech giants, and investors are gambling with your future. And the stakes? Well, it's nothing less than the stability of the United States itself. Today, we're pulling back the curtain on what some are calling the casino economy, where risk is rewarded, safety nets are shredded, and the house, well, they always win. Welcome to That's Life, I swear. This podcast is about life's happenings in this world that conjure up such words as intriguing, frightening, life-changing, inspiring, and more. I'm Rick Barron, your host. That said, here's the rest of this story. I'm an avid reader. I love reading books, newspapers, and blogs, and I'm always on the lookout for something intriguing to write about. Recently, one caught my eye in the New York Times. As I was reading the article over my morning coffee, I noticed the name of the author, Kyla Scanlon, author of the book, In This Economy. I like Kyla. She is a master at explaining the most complex and confusing subjects with wit and creativity about the economy. Whether it's the mechanics of the U.S. debt ceiling, the vibe session, or the nuances of investing, Kyla is here to make it sound so simple to understand. Now, Kyla is an economic commentator and Bloomberg contributor who specializes in human-centric analysis that demystifies the complex, and she can do it. She started her career as a car salesperson before becoming an associate at Capital Group, conducting microeconomic analysis and modeling investment strategies. Now, she recently wrote a guest essay for the New York Times, the one I'm talking about, and its title is Trump's Casino Economy Now. You'll Probably Lose. Now, as I began writing the script for this podcast episode, I realized that to capture the essence of the story truly, it was best to let Kyla's own words do the talking. That said, you'll hear this entire episode in her own words. I love her use of analogies in this article, as it captures the essence of where we are as a nation today with our current economy. Again, Kyla's simplification of what is happening is amazing. So let's get started with Kyla's article, again, in her own words, as it should be. Let's begin, shall we? Step into the casino that now passes for the American economy. Donald Trump campaigned on bringing back American manufacturing and rebuilding what America once was, factories, workers in hard hats, from the ground up. But the investment needed to get there, in both the factories and the workers, hasn't happened. What he has ushered in instead is a casino economy, built on speculation and risk. Across markets and policy, wagers on the future are being made with other people's money at a cost that could prove catastrophic. This economy is largely defined by froth. What was once a fluke has become the operating system of modern markets, like stock prices largely driven by sentiment rather than fundamentals. Recall GameStop and AMC in 2021 and the dot-com boom, the overwhelming power of social media, and the flurry of bets on something not quite real. Look, and you will see gambling throughout the economy, in markets, policy, and how we talk about the future. The tech giants spending billions on AI data centers and the power grid to sustain them. A government shutdown over America's ability to keep their health care. Tariffs used like poker chips to try to shrink the trade deficit. The increasingly erratic treatment of the U.S. dollar. The rise of over 13 million meme coins. JP Morgan now allowing institutional clients to use Bitcoin and Ether as loan collateral. Venture capital funding companies that let people bet against their bills. And the recent rumbling of bad loans from regional banks. Public and private sectors are rolling dice that the foundations of the U.S. economy will hold under the pressure. Meanwhile, the institutions and programs that help cushion risk, like Medicaid and the social safety net, information systems, independent regulators and Federal Reserve independence, even the legal system, have come under attack. As the public sector steps back from its role as a stabilizer, the private sector has rushed in as a gambler, betting that technology alone can hold the system together. Big tech companies are waging trillions on AI infrastructure that might revolutionize everything, chasing a jackpot that could reshape the world or leave a mountain of empty data centers and broken promises. The AI boom has grown into one of the largest speculative waves in modern history. The sector value of AI-linked companies is 17 times larger than the market capitalization of the dot-com era at its peak, and over 4 times as large as the subprime bubble, according to MarketWatch. Goldman Sachs says that AI-related firms have borrowed a record $141 billion to keep that dream alive. Microsoft, Apple, and NVIDIA alone now account for over 20% of the S&P 500's total market cap, their valuations swelling on bigger and bigger AI promises and creating a concentration so extreme that the entire index moves with them. The promises are grand, such as curing cancer, personalizing vaccines, and medical treatment optimization. Yet many of those dreams have already devolved into next-generation social media apps like OpenAI's Sora and Meta's Vibes. The funding frenzy is turning inward. The companies are spending much of their own money on one another. NVIDIA and OpenAI have entered into a $100 billion deal where OpenAI would essentially use the NVIDIA money to buy NVIDIA's chips. So it's kind of like NVIDIA paying themselves $100 billion for their own product. Many AI companies are starting to make their own products free too, with Perplexity offering its previously $200 per month browser for the low price of $0. The boom can't last forever. According to Bob Elliott, chief executive at the financial firm Unlimited Funds, hyperscalers, cloud providers that provide huge global data centers to provide computing power and services to power AI, are planning to slow the pace of spending growth. The hyperscalers are still estimated to spend about $1.2 trillion into 2027. And hopefully, as the backbone of the economy, they will. But the AI spending boom, the billions, roughly $300 billion this year, being poured into the chips, servers, and power infrastructure to keep these systems running, may already be peaking. There is no cushion for the enormous risk that the AI companies and investors, and therefore a typical American 401k holder, are taking on. AI companies represent roughly 75% of the recent S&P 500 earnings growth, 80% of profits, and 90% of capital expenditure. The government is gambling that blanket tariffs will somehow restructure global trade in our favor, despite no historical precedent for this approach succeeding against piles of evidence suggesting it won't. Soybean farmers need a bailout. Scotch whiskey might get an exemption, not to help Scotland, but to protect Kentucky bourbon producers. The tariffs are turning into a rather lucrative side hustle for the administration. Trade lobbying has boomed, and carve-outs are growing. 2 signs that the bureaucracy is certainly making some people very rich. At the same time, Washington is betting that the dollar maintains its reserve currency status during this tumultuous time, as we weaponize it unpredictably and alienate traditional allies. The U.S. dollar has been posting poor performance all year against other currencies. As the economy becomes more unpredictable, Mr. Trump and Republicans have shrunk the safety net that catches people when volatility catches up with them. They cut Medicaid and did not extend Affordable Care Act subsidies in order to fund further tax cuts. Social Security and Medicare are on the table for reform. This is the cruelest logic of the casino economy, stripping away health care coverage from working-class Americans to give tax breaks to companies gambling on speculative ventures, reducing food assistance to fund capital gains preferences for investors playing the meme coin market, firing hundreds of thousands of federal workers to save money while bleeding institutional knowledge and capacity. The math doesn't work. The morality doesn't either. In this economy, individuals bear the downside risk, while corporations and the wealthy collect the upside. It's a rigged game where the house, seemingly the already rich, always win. The question is why this hasn't all collapsed yet. Well, the answer is actually simple. Time. Economic systems have inertia. Institutions built over decades don't crumble overnight. The dollar's global dominance rests on 80 years of habit, and there really is no viable alternative. And as the economist John Maynard Keynes warned, markets can stay irrational longer than most people can stay solvent. But the floorboards are starting to creak. Consider 3 scenarios for how this plays out. The jackpot nobody really believes in. Maybe the bet pays off. AI productivity gains materialize. Tariffs coincidentally align with a global trade rebalancing. The dollar remains dominant through sheer force of habit and lack of alternatives. Cutting social programs doesn't trigger healthcare disruption or social unrest because private charity and family networks pick up the slack. The stock market stabilizes as new AI justified valuations. This requires essentially everything breaking right simultaneously, the equivalent of hitting several slot machine jackpots in a row. Other scenario, the control burn gets out of control. More likely, we'll see a rolling series of smaller crises. A major AI company admits its infrastructure isn't generating returns, triggering a sector-wide repricing. Tariff retaliation hits specific industries hard: agriculture, automotive, aerospace, creating regional economic pain. A health crisis hits Medicaid-dependent regions particularly hard. Each crisis is manageable in isolation, but they compound. Market volatility becomes the norm. Consumer confidence wavers. Business investment pauses. We enter a prolonged period of economic anxiety, with low growth punctuated by frequent shocks. Then the third scenario. The foundation buckles. The nightmare scenario is that too many bets go bad simultaneously. An AI bubble bursts just as trade tensions escalate into a serious global trade war. The dollar faces a real challenge from a coalition of nations tired of U.S. economic unpredictability. A major bank or tech company fails, exposing interconnected risk, as we are just seeing glimpses of now with the recent bankruptcies of Tricolor and First Brands, which is threatening the swelling private credit industry. As Jamie Dimon, the chief executive at J.P. Morgan, put it, when you see one cockroach, there are probably many more. Unemployed workers have nowhere to turn. Consumer spending craters. What starts as a market correction becomes a full-blown economic crisis. The scary part? We wouldn't necessarily see a crisis coming because casinos are designed to keep us playing until suddenly we look down and realize all our chips are gone. Economic crises often appear suddenly, even when they've been building slowly. In a real casino, the math guarantees the house wins over time. We will likely see some winners, the AI giants collecting billions in investment before delivering returns, the private equity firms buying up distressed assets when bets go bad, the ultra-wealthy who can afford to lose on speculation because they have enough diversified assets, the political class that makes the rules while being insulated from consequences. But we will likely see losers too, and there are likely to be many more Americans in that category. Sure, economies run on risk, growth, and ambition, but there's risk, and then there's reckless gambling. When safety nets are stripped away to help absorb the losses if bets don't turn out, when trust is lost, excessive risk-taking stops becoming productive and morphs into something predatory. Casinos run on illusion, the belief that the next hand will be different, but economies don't have to. Well, that's the end of her article. I think it says a lot here. So what can we learn from this story? What's the takeaway? The takeaway from this story is a sobering one. America's economy is no longer built on production, innovation, or shared prosperity. It's built on speculation. The U.S. has drifted from an economy grounded in manufacturing and long-term investment to one that increasingly resembles a casino, where both government and corporations gamble on risky, short-term bets with other people's money. From AI to tariffs to crypto, the underlying pattern is the same. Enormous wagers made with little accountability and shrinking safety nets for ordinary Americans if those bets fail. Now, I think the lesson is clear. When hype rather than fundamentals drives an economy, and when public safeguards are stripped away, risk doesn't disappear. It gets transferred. The winners are the few who can afford to lose. The losers are the many who can't. So in short, we've replaced steady investment with speculative frenzy. We've weakened institutions meant to protect against economic shocks. And we've let the illusion of endless jackpots distract us from the fact that in this casino economy, the house, the wealthy and powerful, always win. The deeper moral? Real economies aren't casinos. They're built on trust, production, and people. And once those foundations erode, no one's chips are safe. Well, there you go, my friends. That's life, I swear. For further information regarding the material covered in this episode, I invite you to visit my website, which can be found on Apple Podcasts, for show notes and the episode transcript. As always, I thank you for the privilege of you listening and your interest. Be sure to subscribe here or wherever you listen to podcasts so you don't miss an episode. And we'll see you soon.